Hey everybody, thanks for tuning in and watching this video on this Excel worksheet that I created to teach the amazing power of compounding interest over time, and more importantly, letting you play the what if games. What if I earn a different amount of return? What if I invest more or less money? What if I invest at a different age than other people? What does that really do to my financial standing over time? So what I've done here in this worksheet, I've created this little field up here where you can input your own numbers, and you'll notice that these numbers will cascade down the entire worksheet, your starting amount and any annual contribution, right? And these two columns, by the way, you'll see that I've tagged them as user changeable. You can change these numbers for any given year. I would just recommend that as you play these what if games, you undo your way out of any changes, or simply do not save the worksheet, as you will overwrite the formulas that are here. But they are individually customizable if you want to play the what if game on a year by year basis. So let's go up here and take a look at the mechanics of how we've derived the mathematics here. Your starting amount, and you say to yourself, well, that's a really odd number. Why didn't you just pick a nice round number for the sake of example? This is the actual number. That is the average annual IRA contribution in the United States of America, just under $4,000 per person. And 10% happens to be the average rate of return in the US stock market. So you see that I have a starting balance that shows up over here, the annual expected rate of return that's here and auto cascade it down, and then my annual contribution, and that shows up down here. Obviously not in the first year, because your contribution for the first year is your starting amount, and you see that the cascading amount for annual contributions is there. Your starting times your growth rate equals your yearly growth. Add them all together, you get a year ending balance. That year ending balance automatically becomes the year starting balance for the following year. And the mathematics apply again. And then the number comes down and begins the starting year, ending year, starting year. You get it. So one of the things that I really want to bring to your attention is this yearly growth chart. Look at what point your earnings, year number 9, look at the part where your earnings actually start to exceed your annual contribution, where you're now doubling or better your money every year in your overall year ending balances. So it doesn't take long to get started in a nice aggressive stock fund, and you can start doubling your contributions or your growth in just a decade. 10 years goes by very quickly. And I've gone ahead and I've broken out the numbers so that we keep a rolling tally of your ongoing contributions and a rolling tally of your annual growth. So here's your total, and then here's how much you put in, here's how much was pure profit, and I took these numbers and I graphed them out. Now take a look at this graph. This is the ultimate secret to wealth. It is the hockey stick chart. So at some point, your earnings look like they're pretty modest, even up to your 17th year and your 20th year. Not very exciting. You do see some growth, but it's not staggering. And then you get the interest on your interest on your interest on your interest on your interest, compounding and producing this incredibly sharp slope of growth. Your objective as an investor is to start as early as possible, to add as many years in this vertical climb as you possibly can, and take a look and see what's happening. Look, these are your growth numbers. Imagine earning in your investments over $100,000 a year. Well, you'll be doing that in your 60s, when you're age 65, if you started at age 30. What if you started at age 20? Right? Or let's say 25. Let's say 25. You started doing this when you graduated college and got your job. Age 25. How soon am I making $100,000 a year? Age 60, not age 65. right? So you're now adding a tremendous amount of money every year to your balance. And this is really exciting stuff. So let's take a look at some of the other things. What if this 25-year-old person followed this model 41 years, age 65? They end up with just under $2 million investing in stocks. Let's play the what if game. What if they invested in bonds instead of stocks? Average bond return in the United States is 5 to 6%. Let's take the average of that, 5.5%. Immediately, this graph is not as hockey stick like as it was before. Gets a lot more gradual throughout here. And let's see, with almost half the return, will I have half as much money at age 65? Come down here, and you are now not almost 2 million, not even a million, which would have been half. You're at 573,000. That's because you're earning less. You're compounding at a smaller rate every year simply by being in bonds, not in stocks. So this is a way that you can start to play the what if game, right? Here's a great one. And because you may notice that I've made these individual columns user changeable, you can get a little more granular. Let's take a look at this. Let's say we're back to earning 10%. And let's say that you convinced your 20-year-old to invest until they were age 30. Okay? And after age 30, they're going to stop. You know why they're going to stop? Because they're going to fall into the trap that so many people fall into. And they're going to use all of their money to buy their new home, to start their family, put their kids in school, and they're going to divert their available funds to other things. Not ideal, but quite realistic. So let's see what happens. Let's say that you're the average person, just under $4,000 investing, year after year, 10% growth, and you do this from age 20 down through age 30. You will have put in $43,300, and it'll stay that way for the rest of your life. Your money is going to other things in this hypothetical example. What are you going to have when you're 65? You're still going to have $2 million. Isn't that amazing? Because you started early and you let these numbers compound and grow over time. Conversely, let's see what difference it makes if you did this at age 30. At age 30, at age 65, do you still have 2 million? No, you don't even have a million. You're at 800,000. So getting started early obviously has a tremendous amount of impact. Tremendous amount of impact. Let's say you waited until you were age 30 and contributed for the rest of your life. Okay, you didn't start at age 20, you started at age 30. Come down here to age 65. The 20-year-old who invested for 10 years and stopped had 2 million. You who waited until you were 30 and invested the rest of your life. See this? You invested the rest of your life till you were age 65. You're under 2 million. That's powerful. That really tells the story of how important it is to start early. So go grab the kids, sit them down in front of the computer, play this game with them, show them that putting some money aside now, as soon as they're able to get some money, as soon as they get those Christmas presents, as soon as they get that birthday confirmation, quinceanera, uh, you know, bar mitzvah, bat mitzvah, however you get your money when you're a kid, rake some leaves, mow some lawns, shovel some snow. Uh, it's far more important for your kids to put this money away than to buy, the next Xbox or a mini bike or a go-kart. This would be what you need to focus on. You need to get on this game as soon as possible so that you can get to these outlying years where your growth is exponential. That is really the power of compounding interest over time. I hope you got a little bit of enthusiasm towards investing now that you've played with this, I will make this worksheet available online, and you can download it, play with it all you'd like. Just remember, if you change any of these numbers, undo, there's the undo button, or Control Z, right? Undo any changes, or simply don't save the worksheet, because you'll destroy all the formulas that are a part of these calculations. But if you want to change them one by one, play the what if game, knock yourself out. I did that intentionally. The rest of these columns are locked. You can't make any changes to them because they are the results of calculations and formulas. So thanks for watching. I really hope it helped, and got this little box down here. While the national average for IRA contributions happens to be under 4,000, you are allowed to contribute up to 6 or 7 if you're age 50 and older, and you need to do what's called the makeup years, right? You realize too late that you didn't get started on time. You have no time machine. You can't go back. There is no DeLorean, and you just have to make up for lost time, and the government allows you to do that both in your IRA and in 401k plans by giving you much larger contribution amounts that you can work and catch up. Fighting against Father Time, but getting these upper years, this upper slope in the outlying years is crucial to wealth creation. Thank you so much for watching. Hope you had a great day. Bye.